What's up, y'all? Welcome back to the channel. What if I tell you that you can save 0.50 or 0.75% on the mortgage that you're going to get in Q4 2022 and 2023 in Q1? I'm going to share a secret that banks don't really want you to know, not many people know, and this is a legit technique as to how you can reduce your interest rates when you buy the mortgage. So watch the full video. Have you been wondering what's going on with the housing market? And you might be seeing that housing market is headed for crash landing. Many developers and big buyers are saying that the condo projects will be problematic because buyers are moving on to the rental. Are you wondering, is the housing market is really crashing and what is going on? You might be wondering why the home supply is up for the first time in nearly 3 years. You might be hearing a ton into the news. Also on Redfin, Zillow, many sites are showing lower price point for homes to buy. Sellers are willing to sell their home at lower price, and a growing share of home listing are stale as the market is cooling down. You might be hearing a ton about home mortgage rates are keeping home buyers on the sidelines, leading to a declining home sales and building up a supply. This is precisely what I'm going to share in this particular video as to how you can get 0.5% lower interest rates on your home mortgage. The number of homes are stale nationwide starting June because the first time annual increase since July 2019. The pandemic, before the pandemic fueled home buying frenzy that is started to cooling off, and with the combination of more than 6% interest rates, take a look right here with 7% mortgage interest rates, it's game over for the housing bubble. The 30-year mortgage rates has surged from 3% before a few years, couple of years, to 7% right now, which is really big. Housing prices are now falling at a similar pace as to what we have seen in 2008. The beginning of the year, a couple with $100,000 annual income could buy a house worth $721,000. That is standard 36 DTI, which is debt to income ratio. Now their purchasing power is only $486,000, which is a drop of 32% in buying power over the span of few months. A runaway after the pandemic, that was the boom in 2021, was insane. People were buying left and right, and right now what we are seeing is the home supply is up for the first time in the history for last 3 years. Now what is going on? The country's economic woes have already cooled down with the housing market. I am going to show you how you can negotiate your interest rates when you purchase for mortgage in a legit way, and you will definitely be getting 0.5% lower mortgage rate when you're applying for the mortgage, because they're likely to continue dampening the demand. Now Fed has signaled that it may increase the interest rates furthermore to a slight level, but we are not seeing that it's going to hit 8 or 8.5%. Otherwise it will be a really big turbulence in not only into the real estate market, but it will be a big recession for the history of United States. Now with the inflation that you can understand that could harm the consumer confidence, and lower stock prices also means there is some perspective for the home buyers that can afford the down payment. We advise a seller to commit. Now I am not a financial advisor, so do your own due diligence, but if you decide to sell, do it quickly before the demand is potentially falling further, and the price carefully, because this is not the time to test the waters. You will do more harm than good if you're overpricing your home that you're trying to sell, and you have to do the price adjustment reduction or to take the home off the market. The market is mixed bag for buyers as well. They're seeing higher monthly housing payments than the earlier that they saw this year due to the comparatively higher mortgage rates that we just talked about. The 7% rates are going higher, but they're also facing less competitive environment for the homes, which offer allows them to make less risky offer that includes a potentially protected risk for like inspection or some sort of appraisal contingencies, so on and so forth. Now what you need to understand when you are seeing 7% mortgage rates, let's take a look at what this Wells Fargo shows us in terms of the mortgage at the moment. Now if you take a look at the jumbo loan for certain more than certain amount, it is called exceeding amount amount confirming the jumbo loan, and their loan limits for 7 by 6 arm is 5.21. Take a look at 30-year mortgage, 5.50%, 5.5%. Many people are going for the confirming loan, and 30 years fixed rate for the loan is 6.62%, which is insanely high. For the 30-year fixed rate jumbo loan, it's 5.50%, which is very high as well. If you think about 30 years fixed rate mortgage, the APR is 6.82. Now, if you want to find out how you can reduce your mortgage rate, you need to understand the ARM, which is called adjustable rate mortgage. Now, if you take a look at 30-year adjustable rate mortgage, it's right now fixed rate is 6.62. As to what the adjustable rate mortgage for 7 by 6 month ARM is 6%, which means you are saving 0.62% just right off the bat, which means you're getting that lower interest rates. Now, how you can do it? Yes, there is risk associated with that, but with this high interest rates that you are seeing at the moment, it's not really huge of a risk. What that means is I'm going to share what is adjustable mortgage rates with you. Now, adjustable mortgage rates, also you need to understand what is the difference between adjustable mortgage rates and the regular mortgage rates and how it works. And adjustable mortgage rates, or it is called ARM, it is the home loan with the variable interest rates. With an ARM, the initial interest rates is fixed for a period of time. After that, the interest rates apply on outstanding balance for the rest periodically. So in this example, if you take a look at, if someone got a loan, adjustable mortgage rate 7 by 6 months ARM, which means for the first 7 years, their interest rate is going to be 6%. Now, for the rest of the period, it is going to get adjustable or it's going to be variable, and it depends upon what the adjustable interest rate at that time into the market. Now, if you think about, if you buy that loan, the same loan today with the fixed rate, you're getting at 6.62%, versus if you get 7 by 6 month ARM, you're getting at 6%. So every $100,000 that you buy the mortgage, you are going to save $625. Now, if you think in other words, with this high interest rates after 7 years, most potentially the interest rates are going to go lower. Now, if it does not go lower, then you always can refinance. So that's the catch. You really need to understand that you're willing to go for refinance after 7 years in case of the interest rates are higher. But with this high interest rates, it's going to go lower. Now, in 5 years, how much money you're gonna save? You're going to save 0.6% times 5, which is 3% of the interest rates that you're just going to save, which is a huge saving. For every $100,000, you're going to save $3,000. So you want to understand that. What is the key takeaway that you want to learn for this key adjustable rate mortgage? And contact your bank and they can give you more information if you ask them for. No one is talking about ARM that frequently, and I wanted to share with you so you can get advantage of this. Hit the like button if you haven't already. Subscribe to the channel because this is going to save you thousands and thousands of dollars. Write down in the comment section below if you already bought the ARM or if you already bought the 30-year fixed mortgage rate. And with that, what did you learn? The key takeaway here is an adjustable mortgage rate, or ARM, is a home loan with an interest rate that is fluctuating periodically based on the performance of a specific benchmark, which is mostly what the Fed decides in terms of the interest rates that we have been seeing for last many months. That Fed is rising interest rates at the moment. There will be time when Fed will start declining those interest rates as well. One of the reasons why Fed is rising the interest rate is because of the inflation and what we are seeing in terms of the concern into the market. ARMs are generally have caps for their limit as to how much the interest rates and or the payment can rise per year over the lifetime of the loan, which does mean that it's not going to go skyrocket high. You want to understand what is your cap. That means as high as a particular loan can go. You can always ask the bank and they can give you in writing as well. And ARM can be smart financial choice for the home buyers who are planning to keep the loan for a limited period of time. Now, if you're not planning to keep it a limited period of time, you can always refinance after 5 years, after 7 years, so on and so forth. I'll be talking about 5 by 1 ARM, which is most popular way for ARM, and people are leaning towards 5 by 1 ARM. And I'll tell you why exactly they want to do it. They're planning to keep it for a period of time at certain interest rates, and then the interest rate will drop as much as whatever it is into the market, and that can afford by potential increase in their interest rates as well. Now, if you think about 5 by 1 arm, I just talked about a 5 by 1 arm is adjustable rate mortgage loan which with a fixed interest rate for 5 years. Afterwards, 5 by 1 arm switches to adjustable interest rate for the remainder of the term. The word variable and adjustable are often used interchangeably. When people refer to variable mortgage rate, they're likely to mean a mortgage with an adjustable rate. A true variable mortgage has an interest rate that changes every month, but that might not be common. It might be changing every 6 months or every 1 year. The arm has a fixed interest rate for the first several years. But for 5 by 1 arm, it will be same or fixed interest rate for first 5 years, which means 6% in our example. It will be 6% for first 5 years, and then it can change. An arm with the fixed interest rates for first several years, loan arm that is called often teaser rate. So teaser rate, after the teaser rate, why it is called teaser rate? Because it's lower than any comparable rate that you can get at the fixed mortgage rate, which is the key, which is the secret that you want to learn, that you can get arm at a lower price for the mortgage interest rates in any given market. The rates may be fixed for 7 to 10 years. All the 5-year arm is very common, very popular option. One of the fixed rate option that you can get is arm adjusts up or down based on the current market rates that you want to understand, which is subject to cap governing how much the rates can go up or down in particular adjustments. Typically, the adjustments happen every year or once per year based on what the Fed sets for the market rate. So I hope you learned this at this point. I wanted to point you to another section where we are going to see how the median sales price is going to look like. Right now, if you take a look month over month, and this is the data for August, and we are still waiting for data for September, and I'll share that with you. Hit the like button if you really get value out of this video. Subscribe to the channel as well so you don't miss out on many of my videos. If you click the like button, in future it will recommend these types of videos on your homepage on YouTube. Now take a look right here. Last month, it's not September, August, we still see that Albany month over month median home price are increasing by 9% more or less. Allentown, PA close to 7%. However, in Anaheim, California, we started seeing it started going down and it was negative 4%. Why is that happening? Because we saw that the technology sector got hammered a ton than any other sector. If you take a look at Georgia, Atlanta, Georgia, it is staying pretty much same. Austin, Texas, which was another hot market due to the technology boom that we saw in Austin, Texas, started going down. It declined by 3.2%, as you can see, month over month, which is pretty big. In Idaho, we started seeing 4.5% decline, which is pretty big as well. Take a look what's going on with Detroit. We are still booming, but again, it is not impacted by any technology sector or anything that we started seeing decline in terms of the business. Take a look, South Carolina started declining because it went up so high, 13.6% for South Carolina. It's a pretty big number. Illinois, take a look, 9.4%. We are not still seeing decline just there, but the most important thing that you want to also notice is what happened in Florida. It is sustained on some parts of Florida. However, we saw Florida, Orlando 0.8%, so which is pretty flat. If you start taking a look at further and further in Fort Lauderdale, Florida, we are still doing pretty good, and we are Tampa, Florida, we're up 2.2%. But this market has been rising very high, 26% in Tampa, Florida. Can you believe that? In just 1 year, in 12 months, the home price is appreciated by 26.1%. which is pretty high in my opinion, and they will be the first one will start declining as soon as those market will start getting hit. And Florida housing market, which went so high, it's going to get back down very soon. We are seeing major buyers in Florida market right now for last 3 to 5 years that have been buying left and right, which is going to end very soon because people are not going to be able to afford the high price points that we already started seeing last year and following into 2022. So you want to keep that in mind as well. If you start buying at this point, you might want to once again remember that we are seeing 7%, as high as 7% mortgage rates, and people are talking about housing bubble, housing market crashes coming up, mortgage crises are coming up as well, and you want to do it accordingly. Once again, if you like this video, hit the like button, subscribe to the channel so you can get notified next time I post a video on mortgage crisis or the real estate crisis or what is going on in terms of the housing market. Hopefully things will settle down very, very soon, and I'll have some good news to share with you. Thanks for watching. I will see you in the next video.